The European Central Bank looks set to cut rates again. As well as more easing today, policymakers are also likely to keep the door open for more cuts this year, as concern over growth and the lack of it seems to have overtaken those inflation worries. Jamie Lindsay is an investment analyst at Artemis. Jamie, what's your take on the challenge facing ECB policymakers this year?
So, as you say, a rate looks dead set for today, almost 100%, if not more than 100% priced in by the market. So there's a tail risk that they might even cut, well, double today. I think the challenge here, both for the ECB, but also for markets, is that over the last few years, central banks have been, or market expectations have been extremely myopic. So you've gone from expecting lots of rate cuts to no rate cuts, and now markets are looking at 2, potentially 3, and there's a small chance of even 4 this year. As you mentioned, there's a really difficult balance between stimulating growth and managing inflation, and there seems to be much more of a focus on growth at the moment. From the start of the conflict in Ukraine a couple of years ago, Europe has experienced meaningfully higher energy prices across the board, which is causing growth to struggle. And at the moment, you have got this kind of overhang and uncertainty with Trump and tariffs from the US and the potential implications on the European economies. But from where we sit, there's one thing that we find quite interesting, which is there's a lot of talk about US exceptionalism and far faster US GDP growth. But actually, and potentially topical this week, if you were to exclude Nvidia from the US stock market, the MSCI Europe index has actually performed as well as US over the last 2 years. So perhaps Europe hasn't struggled as much as the wider perception is.
Let's drill down on some GDP data though. Today we had some Eurozone numbers and it showed the economy stagnated at the end of 2024, and the bloc's largest economy, Germany, has actually been shrinking for 2 years. Is a recession now inevitable?
I think weaker data is inevitable. We have seen a trend over time of reported GDP numbers later being upgraded. I think Germany looks to be in a particularly difficult situation, partly due to its industrial exposure and particularly its exposure to the auto market, where its largest companies have struggled with the adoption of EVs and with particular competition from Tesla and the Chinese EV makers, alongside this issue of higher energy prices. I think, well, all else being equal, you could see, and it's likely you will see Europe as a whole fall into perhaps a mild recession. But again, going back to the impact of the US, if Trump is able to resolve and cause a peace deal or a ceasefire in Ukraine, that could radically change the outlook for energy prices in Europe if Russian gas and oil were to return, and would be significantly stimulating for EU GDP and Eurozone GDP.
Well, let's look ahead to next week, and it's the turn of the Bank of England. Again, it looks like a rate cut is almost a certainty. But how many cuts do you think the UK Central Bank will actually deliver this year?
So the Bank of England has a very challenging job because, of course, inflationary concerns have lowered versus the peak and the cost of living crisis. But we had an inflationary budget from the Labour government late last year. Now, currently markets are pricing in 3 rate cuts for this year, which would leave rates around 4% at the year end. And our view is that that would actually be very stimulating for the UK economy. One sector we look at is UK house builders, and the publicly listed house builders talk about 4% rates being a crucial level for them, as it's the point at which buying houses becomes more affordable than renting. So my view is that 3 rate cuts seems plausible and would be very stimulating, and in the example of house builders, would enable volumes to increase materially in the face of higher demand, and would also be really supportive of GDP growth and perhaps take us in the direction of the 300,000 homes a year target of our current government.
That was Jamie Lindsay at Artemis. And you can get more news, analysis and videos like this one on Reuters.com.